Now, our main focus point today is about how Buffett did it. And I love this topic because Warren Buffett's success is, I think, in many instances, misunderstood. A lot of people think of it as just great stock picking, but it's far more than that. Now, he has outperformed the major indices by about a couple percentage points over a long period of time. But that doesn't sound like a lot, but when you compound that 1 or 2% beating the index each year, that becomes a big number over 30, 40, 50 years, right? And that's how you become one of the richest men in the world. Now, if you study his process throughout the years, it comes down to three things. Buying high quality, low risk businesses at reasonable prices. That's the stock picking part, which is challenging, but not impossible. Uses a fair amount of leverage to amplify those returns. That one is the most difficult to replicate. And then manages that leverage very carefully so that in rough times, he doesn't go out of business. And a lot of that has to do with the type of business he owns that tend to be less cyclical and very cash flow heavy, right? So that part, like I said, isn't that difficult. But the leverage part is. He typically uses about a 1.6 to 1 leverage ratio. That boosts his overall risk, yes, but creates excess returns. Now, on the stock picking side, you want to pick companies that are profitable. That's not that difficult. You can see if they're profitable or not. What's a little bit more difficult is identifying ones that will stay profitable for not just the next 2, 3, 4, 5 years, but the next 20 to 30 years, right? That's probably where you say his stock picking prowess comes in the most, is that quality factor. Difficult, but not impossible. And if you actually run the numbers and you use the same amount of leverage and you bought similar type of quality and profitability, you'd have similar results. Similar, maybe not exact, but in the ballpark, shall we say. Now, what's difficult to replicate, though, is that leverage. And what he's doing is leveraging the premiums from his insurance business, from Geico. And it's effectively low-cost financing for the investment side of the ledger. Now, if most people try to use this type of leverage, they eventually get margin called because you have bad periods in markets, and that leverage suddenly creates a margin call from your broker during bad times, and you have to sell at the worst time. But insurance customers don't have margin calls. And it's very easy to know, generally, if you have enough customers, diversity, running actuarial tables, and you know kind of when that money is going to be needed. And so you can manage that leverage pretty easily. Now, that's one of the reasons why what private equity is trying to do is they're trying to adopt a similar strategy. Think Apollo or Blackstone. And that's one of the reasons why private equity is not very liquid. They're trying to say, hey, you can't margin call us. We're going to stick through the bad times and we're not going to get margin called. And they do that through, gating redemptions. Problem is that at some point, things get bad enough, investors are going to want their money back. And so that's the challenge with private equity. It's something they're dealing with right now. Another factor is that even when there are rougher periods, which Berkshire, if you go back in history, definitely has mediocre periods, very below average periods, but also has a good strings of very good periods of performance. But because of his sterling reputation, nobody's really jumping ship for the most part. And then you look at his relative volatility, tends to be a little bit below 1 on the beta scale, meaning less volatility than the overall S&P. And The reason for that is because the businesses, they tend to be less cyclical. And he actually thrives in those times because he always has some level of cash on the balance sheet because a lot of those businesses throw off cash. And he goes in there and he buys up assets when times are roughest. And he has that faith from his supporters to not pull the money out or demand changes when things are maybe performing below par. And a part of that is the fact that, he shows up at those annual meetings and he's always had insightful, down-to-earth comments that really calm investors. And he's been doing it so long, and he did all this well before really value investing was popular, when there was enough data to really do deep dives on these companies. That's one of the reasons why his edge is kind of waned over the years, is because he's not the only value investor out there. He used to be one of a handful of ones that had the data, the discipline, the expertise to execute these type of strategies. Now it's more widespread. And so his unique achievement is building a business structure with Geico and that leverage, and then building that reputation so that even during rougher times, he's not getting margin called, he's not getting pressure from outside investors to make changes to his approach. And he's kept that approach for 50 plus years. And that's what has made him successful. So it's a little bit more complex than the average person wants to make it out to be.